In this video, we'll explore ICT's optimal trading zone and optimal trade entry. This approach is mainly built on Fibonacci retracement levels and natural price swings, helping us enter near the start of future impulsive movements and outline potential targets. We've broken this trading method into 3 simple steps: analysis phase, trade execution, and management. We'll demonstrate how you can blend this idea with market structure, fair value gaps, and important levels from higher time frames to carry out high-quality trades. So, if you found this useful, please like the video and subscribe if you're new to the channel, and turn on the notification bell so you never miss our latest uploads. I'll see you right after the intro and disclaimer. When we open the charts, the first thing we must do is identify price swings and key structural levels. In simpler terms, it's crucial to complete a top-down analysis from higher time frames to lower time frames to gain a clearer view of market conditions at each stage. When we mention higher time frame levels, we are referring to weekly, daily, and 4-hour charts. A shorter time frame makes it more short-term for large institutions to refine their execution plans. If we detect the price dropping below a higher timeframe resistance, we can reasonably assume that institutions showed selling interest at that moment. However, if the price pushes above a support level, it suggests institutions may have bought at that zone. This way, we can evaluate small intraday movements. Don't panic, we observe large movements that signal major participants are controlling the market. These bigger trends are only visible on higher timeframes, and we constantly stress how critical this is for analysis. So, recognizing higher timeframe swings and key levels allows us to grasp the broader market direction and avoid getting trapped on the wrong side. We can then zoom into lower timeframes, such as 1-hour or 30-minute charts, to locate potential trade setups. If you study the charts, you'll notice the market consistently shifts in impulsive and corrective waves. This fractal nature of the market is caused by the actions of market participants. Impulsive waves push price quickly in one direction, and these candles usually share the same color with wide bodies. Corrections instead show uncertainty where candles are mixed in color and have small bodies, along with sideways wicks. Spotting the end of a pullback and the start of a fresh impulsive move can be significantly profitable, as it allows traders to identify strong buying or selling positions. Opportunities can emerge. Suppose we are in an uptrend and want to buy low and sell high to benefit from this bullish environment. We cannot buy now because the price is already high and may drop anytime. Therefore, we must wait for a correction to enter at a fairer value. The latest impulsive move began here and expanded up to here. The correction will develop inside this zone, and once the market collects enough liquidity and bears become aggressive, the market will surge again. If the price slips below this level, it means bears have lost control, and confidence in the uptrend becomes uncertain. This signals bearish momentum is stronger, and a potential reversal can occur. Unless it's a fake out where the market dips under the low to gather liquidity. Now, let's return to the correction area. The concern is where should we place our long positions and where should we enter the market? If we jump in too soon, the price may decline, causing a loss even if our idea was right. If we enter too late, the price may already rally, causing a missed trade. So, the conclusion is to trade with the trend and catch the end of the upcoming correction. This will trigger an impulsive move. Now the question becomes how to do this. This is where the Fibonacci retracement tool becomes helpful. We should always apply this tool from the beginning to the end of the impulsive wave to outline the correction range. When you use this tool, you'll observe multiple levels on the side. All of these important levels can serve as support and can also reject price once touched. However, there are 2 special retracement levels that create ICT's optimal trading zone, OTG. They are the 61.8 and 8.6 levels. There are several explanations for considering this zone as the optimal trading region. The first reason is the improved risk-to-reward ratio. We know that we can enter anywhere. The first target for a trade is the level of the recent market structure. When price reaches this point, some traders close positions or take profit, while others go long. This may also cause a correction or reversal. Therefore, this level becomes our initial target. If you enter inside the OTG, your risk-to-reward ratio will be very strong. We consistently aim to trade with a risk to reward of at least 1 to 2. Therefore, trading inside the OTG gives a higher risk to reward ratio and a more logical trading plan. The second reason is safer entries. The market likes to remove early buyers and use them as liquidity for future expansion. So, if we wait for price signals to enter a security and then search for triggers to go long, our win rate rises immediately. Of course, every strategy contains weaknesses. In this case, we might occasionally miss trades because of a careful approach. But a missed trade is always better than a losing trade. The third reason is safer stops. The most reliable region to place a stop loss to shield us from volatility is below the swing low. Because if the price drives under this level, the market structure changes and bulls will attempt strongly to defend this zone. Therefore, the nearer your stop loss is to this level, the safer it becomes. This is the third reason we take trades within the OTG. After understanding all of this, if we discover an appropriate entry region inside the OTG zone, it can be a high probability move. This entry area could be any price action confirmation, which we will review later in this video. Now that we have understood optimal trading, now that the zone is identified, let me explain ICT's optimal trade entry concept. This model is divided into 3 simple steps: analysis, execution, and trade management. Let's begin with the analysis phase. As mentioned earlier, this strategy is a trend continuation setup, where we anticipate the end of a pullback or correction and enter in line with the dominant trend. In this first step, we need to determine the market direction and identify the latest impulsive wave. We only use this setup when the direction is clearly defined. The recent impulsive move must break the market structure to be considered valid. One more point remains. We need to verify whether the price has sufficient room to move before reaching a key higher timeframe level. If the price has already touched the supply zone of a higher timeframe, we will avoid taking a buy trade without confirmation, as that key level could reverse the entire uptrend. In general, during the analysis phase, we focus on 3 things: the market direction, the most recent impulsive wave, and how much space is left until the higher timeframe level. The next step is trade execution. We evaluate the price pullback and apply the Fibonacci retracement tool from the start to the end of the impulsive wave. Then, we place a buy limit at the midpoint between the 61.8% and 86% retracement levels, which corresponds to the 70.5% level. The stop loss is placed a few points below the swing low. The final step is trade management and setting targets. We know that when the price reaches this area, it may face resistance and could reverse lower. Therefore, our first target is set just before this level, which could align with the close of the highest candle. For the second and third targets, we aim for the 276% and 161.8% Fibonacci extension levels. Now, let's quickly review the bearish scenario. Applying the same principles, the first step is to identify the downtrend, the latest bearish impulsive move, and the remaining space until the next significant area. Our goal is to go short in line with the dominant trend and take advantage of bearish momentum. This requires identifying the pullback range. The latest impulsive move began here and declined to here, marking the zone where a correction or reversal can be expected. Next, we use Fibonacci retracement levels to determine the entry. Here, we set a sell limit at the 70.5% retracement level and place a stop loss a few points above the swing high. The first target corresponds to the close of these candles, as this level is likely to act as support when the price retraces. The second and third targets are set 27% and 68.1% above the retracement levels. This is ICT's optimal trade entry model. As you can see, the entire model relies on basic price swings and retracement levels. Some may wonder how trading can be so simple yet profitable. Simplicity is key in forex trading. Your trading plan should be clear and mechanical, with clearly defined entry, stop, and target levels. With such a setup, you can trade confidently because it has been backtested, and emotions play no role in trading decisions. Consequently, your backtesting results closely reflect real market performance. This was the basic model. We have since enhanced it with smart money concepts, including fair value gaps, market structure shifts, and multi-timeframe entries. Let's now explore these advanced concepts in detail. Let's start by combining optimal trade entries with fair value gaps. There's a clear uptrend here, and we are waiting for a pullback to take a long entry at a better price. If the price drops below this level, the entire uptrend is questioned, as it suggests that bearish momentum has strengthened. Now, here's our correction range. We can apply the Fibonacci retracement tool to identify optimal trading zones. On the left side of the chart, you'll notice that the latest impulsive move created multiple fair value gaps. One of these gaps directly aligns with the OTZ. When price returns to these zones, they act as support and can help push the price back up. A more conservative approach is to wait for the price to retrace to the third fair value gap before entering a long position. This is because the price may use the first gap primarily to gather liquidity, trapping traders who entered early. In summary, combining OTZ with fair value gaps creates a strong supply and demand zone, generating a high-quality trade opportunity. Now, let's discuss combining optimal trade entry with a market structure shift. In a prolonged downtrend, the price eventually fails to make a new lower low for the first time, indicating that sellers' momentum is weakening. The price then breaks the supply level to the upside. This change in character signals that sellers are losing control and a reversal is possible. When the price breaks the structure above the previous high, it becomes a clear indication that buyers are taking over. This marks a proper market structure shift from a downtrend to an uptrend, signaling long entry opportunities to capitalize on the bull market. The question then becomes, when should we enter? Even with a high probability of price moving up, entering at the wrong level could trigger a stop out. Therefore, we apply the optimal trade entry concept using price swings and OTZ. With a bullish directional bias and enough room for price to reach the next significant resistance, we apply the retracement tool to the latest impulsive wave and place a buy limit at the 70.5% retracement level. The stop loss is set a few points below the swing low, and targets are defined according to our trading plan. This approach combines optimal trade entry with market structure to create a high probability trade. However, it's crucial to remember that no matter how promising a trade appears, the market has its own mind. Risking an unusually large amount because you believe the trade will succeed is a poor decision. Trading attempts to predict future movements, which are inherently unpredictable. For example, a 50% loss requires a 100% gain on the remaining capital just to break even. Therefore, survival is more important than immediate gains in forex trading. The third strategy is the 2 timeframe entry. In this setup, we use 2 timeframes to enter trades. Most analysis is conducted on higher timeframes. We then zoom into a lower timeframe, such as 1 hour, 15 minutes, or even 5 minutes, to confirm entries. For example, on the 30-minute chart, we see a clear uptrend. We apply the retracement tool and mark the optimal trading zone. When the price pulls back, we switch to a lower time frame to locate a precise entry zone and take a long position. On the lower time frame, this entire move may initially appear as a downtrend. Our goal is to identify signals indicating that the downtrend has ended, allowing us to take a long position aligned with the bullish higher time frame. Only after observing a change in character can we confidently enter a long trade. In this scenario, the higher time frame trend is bullish, and the price is within an optimal demand area, combining multiple price action concepts and signals to enter a high-quality trade. That's it, traders. Thanks for watching this video. You don't need perfect timing to start. You need courage. If today's video gave you the courage to take that next step, show support with a like. And if this is your first time here, subscribe and ring the bell so you're always tuned in. Every day is a chance to rewrite your story, break old limits, and build new standards. Don't wait for permission, create momentum. Keep believing, keep building, and I'll catch you in the next video.